Substantial job growth surprises analysts. 147,000 new roles added in June 2025. By Mary Cunningham, reporter, MoneyWatch. Updated on July 3rd, 2025, 10:53 a.m. EDT, CBS News. Strength in numbers, US labor market shows continued resilience. In a surprising turn of events, US employers welcomed 147,000 new jobs into the economy in June, demonstrating a robust labor market despite the slow pace of economic expansion this year. This latest statistic aligns closely with the average monthly job creation of 146,000 over the past year, as reported by the Labor Department. What do these figures tell us? The job market is standing strong, outperforming predictions that anticipated a more modest increase of 115,000 positions. According to economist surveys facilitated by FactSet. Additionally, the national unemployment rate dipped slightly to 4.1% from 4.2% in May, marking the lowest level since February and coming in under the anticipated rate of 4.3%. But here's where it gets interesting. Despite the backdrop of uncertainty surrounding US trade and fiscal policies, employers persistently added new positions at a consistent rate. Government employment experienced the most significant increase in June, with 73,000 jobs, particularly in state and local government education sectors. On the flip side, the federal workforce saw a decrease, losing 7,000 jobs due to earlier significant cuts by the Department of Government Efficiency, DOG, accounting for nearly 287,000 job reductions this year alone. Meanwhile, healthcare added 39,000 positions to its tally. And this is the part most people overlook. The Labor Department revised April and May's employment figures upwards by a combined total of 16,000, reinforcing that the job market remains on a stable foundation. This information also carries implications for the Federal Reserve's upcoming decisions. As Jerome Powell, the Federal Reserve Chair, noted, tariffs have the potential to slow down economic activity and increase inflation in the coming months. Powell emphasized that the Fed decided to keep interest rates stable this year, largely due to the impact of President Trump's tariffs on trade policies. What are experts saying about this? Economists highlight that the resilient labor market continues to defy the weak indicators that had been prominent in recent months. Simon Dangor from Goldman Sachs Asset Management expressed in his research note that today's strong jobs report confirms a still resilient US labor market, defying, at least for now, the signs of weakness seen in some leading indicators. The ongoing solid job growth likely means the Fed will hold off on any rate cuts at their next meeting. Some predict 2 reductions by year-end, while others foresee just 1. Nancy van den Houten, a leading economist at Oxford Economics, believes that tariff-induced inflation could peak by the 4th quarter, potentially allowing the Fed to lower interest rates in December to support growth. What do you think about these developments? Do you agree with the economists' expectations about the potential impact of tariffs on the economy? Share your thoughts and join the conversation in the comments below.